All right, folks, I think it's time to get started. Thank you for your patience. I see that we have a lot more people dialing into the webinar as we're chatting, but we will be recording this and sharing with all individuals who have previously registered, so not to worry. My name is Chris Desi. I'm the Chief Revenue Officer here at Diamond Standard, and we're very excited for this webinar today. We've got a treat for you. Firstly, I'm going to introduce an executive from GBI, and then she will be chatting a little bit about Cormac Kinney, founder and CEO. Cormac will present for about 20 minutes, and then we will open the floor to questions, which you can share via the chat feature in the Zoho meeting. So before I get started, I wanted to introduce Megan Jorgensen. She's the SVP of Wealth Management Distribution for GBI. She's got over 30 years in financial services, a Bachelor of Science in Business Sales and FINRA Series 6 and 63 license. She could have chosen a number of places to work, but chose GBI. The leadership team at GBI and the advisors she gets to help have helped pave new ideas in the financial services world. She obviously loves her job. We absolutely love interacting with Megan as a partner. Very excited to introduce Megan. I will sign off now and allow Megan to take the floor. It's all yours.
Oh, you're on mute, Megan.
Good morning, everyone. Thanks, Chris, for that wonderful introduction. Greetings from chilly Minnesota. We're getting ready for spring here. It's not quite here, but I'm thrilled to be here with you today to talk about this new opportunity in the alternative investment world with Diamond Standard. But before that, I thought I'd give you just a quick blurb if you haven't done business with GBI or Gold Bullion International, what we do. We actually work with some of the top RIAs in the industry and help them help their clients either purchase, sell, store, or even take delivery of physical precious metals like gold, platinum, palladium, and silver. We also work with a number of wirehouses and family offices and help them manage their precious metal platform. If you'd like any information on the physical precious metal platform that you have access to, please feel free to drop me a note at mj@gbi.co. And I have the pleasure of introducing Cormac Kinney. He is the founder and CEO of Diamond Standard. He has solved the challenge of creating a standardized diamond commodity. You're going to be fascinated by this. Cormac was the founder of 4 software startups that were all acquired by public companies. He studied computer science at Carnegie Mellon, earning a bachelor's and master's of science degree. And with that, I'll turn it over to you, Cormac.
Thank you, Megan. What I'd like to do is start from the beginning and explain what are the Diamond Standard commodities, how we've created them, what's the benefits, and why we think now is a good time to invest in diamonds, how the diamond commodities have unlocked that market for the first time. If you're not familiar, this is what they look like. These are Diamond Standard bars. As you can see, the diamonds are inside, and the breakthrough is that each of these bars are equivalent. What that means is that the diamonds add up to a public standard. The different carat weights, the colors, the clarities. Under regulatory supervision, they're optimized so that every bar is equal. Because these bars are equal, that means they can be traded on a spot market. They're fungible, and the value of one bar is the same as another, and so you don't have to negotiate and review and evaluate. We also have coins. In fact, between the two of these commodities, the coins and the bars, you'll see that the sizes are different of the diamonds. We include about 94% of all the different types of diamonds that you'll find in a jewelry store. The market price of these commodities today for the coins, I think, is $42.90. I have to look it up on Bloomberg because we don't set the price. Just like gold, the price is based on market trading. The way we make these commodities is very interesting, and the first foundation was that we wanted to get a regulator to supervise the process. That regulator is the Bermuda Monetary Authority. A lot of people ask me, why didn't we get the CFTC? That's a commodities regulator, isn't it? Well, in the US, they can only regulate derivatives or exchanges. They cannot oversee spot commodities. We were very fortunate to get Bermuda to oversee the entire process, and now we have the world's only regulatory license for a diamond commodity in history. Once we had a regulator, their requirement was that we got an auditor to actually go in and test all of our processes, our diamond buying, our custody of client funds, all of the things we do when we're building these commodities. And again, we were very fortunate to get Deloitte as our internal auditor. It's very unusual for Deloitte to audit a startup company essentially, but they saw the potential in this new asset class, and now they've been our auditor for 3 years. We also brought together a consortium of gem labs and custodians and secured logistics partners. In fact, every diamond in the commodities is inspected by 2 gem labs. They're competing. They would love to catch each other making a mistake. And those are the GIA and the IGI. People are surprised. We actually never touch the diamonds or the commodities. They're assembled in the gem lab, and the diamonds are moved globally by Malka Amit, a logistics partner. Finally, when the commodities are produced, they're delivered directly to Brinks. We actually built a custodial vault in Delaware that's operated by Brinks, and we built it there because there's no sales tax. It's because of this foundation of regulatory oversight, audit, third-party verification of all the diamonds, third-party logistics, that our commodities have been approved by multiple regulators and multiple exchanges to be used for trading, spot trading, or to settle various financial products. The result of this is that for the first time, you have a commodity like gold, like a gold bar or like a gold coin. Diamond standard commodities can be traded as any other commodity for the first time. And it's because all of these commodities are fungible, they're equivalent. So in this presentation, I'm going to walk through the investment thesis, why we think now diamonds are a good investment, why we think now is the right timing to build a position in this investment. And the foundation is that diamonds are a natural resource like precious metals or so many others, agricultural commodities or chemicals or coal, etc. But diamonds are actually a very valuable asset class, more than 1.2 trillion. And unlike precious metals, which are easier to trade, we didn't have to make them fungible first. Precious metals like gold, silver, platinum, and palladium are all widely held by investors around the world. In fact, 15% at minimum of each of these precious metals is held by investors, meaning that platinum in a bar on a shelf is owned by hedge funds, family offices, or held by ETFs, for example. But in the case of platinum, 17% of the global supply is held by investors. In the case of diamonds, that percent is only 2% of the above ground supply. And those are the diamonds you see for auction at Sotheby's, for example. Those are investment diamonds. All the jewelry in the world is not an investment. We believe now that we've created a spot commodity and now we're developing various financial products like funds and futures, we think that diamonds will catch up with platinum and that $190 billion of diamonds will shift from the mines and jewelry from consumers will shift over to investors. We think that that shift of that demand will drive diamond prices up fairly significantly. In this chart, we're looking at 20-year price history, and we can see just how far behind diamonds are compared to gold and silver. What you'll see is that in the last 20 years, gold and silver, first of all, have significantly outperformed the S&P 500. A lot of people don't realize that. And in particular, they're up 4 to 6x in the last 20 years. A large part of that price appreciation was actually driven by demand for financial products, because in 2002, the first gold ETF launched. And today, gold ETFs hold over $100 billion worth of gold. That demand, in part, drove the prices of gold up. At the bottom of this chart, you see diamonds, that purple line. And that index is the DIAM index, which you can find on Bloomberg or Refinitiv. That index shows you that diamonds have been relatively flat for 20 years. We'll look at that in a little bit more detail. But first, to zoom in on gold and silver, in the 1990s, gold was flat to down for 15 years. And it was only in 2002, after the gold ETF was launched, that gold began this very dramatic rise in price, that 6 times price rise. In 2005, we saw the same thing happen with silver, that the financial demand for silver, at least in part, drove silver prices up, in fact, about 4 to 5x during the first several years. More recently, we've seen that same trend with uranium. The world's first uranium ETF was launched in 2021 by a company called Sprott up in Canada. They listed it on the Toronto Stock Exchange. That Sprott ETF and one other private fund called Yellowcake in the UK, together over the last 2.5 years or so, they've acquired almost $7 billion worth of uranium, driving the price from the mid 200s to the mid 700s in 2 years. So financial products can very significantly impact the price of commodities. In the case of uranium, those funds acquired over 6 months worth of production in less than 2 years. Now, this chart is a zoom into the details of the diamond price history over that same 20 years, so you can see a little bit more of the details. What I think is very interesting about this chart is you see that dotted line at the bottom has acted as a floor over the last 20 years. Diamond prices have consistently bounced off of this floor, which I believe is relatively close to the marginal cost of production. A diamond mine can't afford to sell diamonds really below that price on a sustained business and stay in business. And what we saw in Q4 of 2023 is that once prices hit that floor again, all the diamond mines stopped sales. And they refused to sell at that price. And since then, diamond prices have recovered by about 6%. So this floor, the marginal cost, seems to provide a downside protection, I believe, in diamonds. That the floor reflects the cost, and there's a lot of upside with downside protection, which is interesting. And again, you can see over 20 years what gold and silver did. They went up 4 to 6 times their price. And so diamonds are starting from a very, very low price historically, and we think that makes it very good timing for an investor to start to build a position. My background is as an institutional trader. I've been a software developer, but I also spent many years as a portfolio manager for major hedge funds, including Tudor Investment Corp and Millennium, which is now a $60 or $70 billion fund. And in my career as a portfolio manager, I never saw an asset like diamonds that has literally zero correlation to every other asset. Diamonds have 0.04 correlation to gold and silver. Gold and silver themselves are about 0.75 correlated, and diamonds have near zero correlation. They're also uncorrelated to stocks and bonds. This means that diamonds are a diversifier to literally any portfolio. They bring down the volatility. They increase the Sharpe ratio, assuming there's positive return. We think we know from institutional investors that that's very interesting, but also the fact that diamonds are a $1.2 trillion asset means that it's large enough for an institution to allocate to significantly as compared to cobalt, for example. No matter what you think of the outlook for cobalt, you just can't invest enough as a multi-billion-dollar institution, for example. Where you see the benefits of that lack of correlation is when there's any period of crisis. Here we're looking at the last 7 financial crises, from the recessions to the financial crisis in 2008 to COVID-19. And the most sensitive asset, of course, are stocks. On average, the S&P 500 lost 20% of its value during each of these dislocations. At the same time, during those periods, diamonds were up about 5%. Of course, this was before financial products were available, but the point is, diamonds can provide very substantial tail risk protection during times of dislocation. Now, I'm a macro investor. I really am most interested in the fundamentals. And in the case of any precious metal, that comes down to supply and demand. In the case of gold, there's constant mining and constant production, but it's really the demand that drives the prices changes in gold, demand by central banks, most notably, or individual investors. In the case of diamonds, supply is the major story. There hasn't been a new diamond mine discovered in over 20 years. The last diamond mines were discovered in far northern Canada. The only other source of diamonds in the last 20 years have been from the bottom of the ocean. And there's now 5 or 6 ships that scrape the ocean floor trying to find diamonds that were washed out to sea over millions of years. All of them together are equivalent to perhaps one mine. But right now, as far as the kimberlite pipes, which is the concentrated diamond mine, there's only 47 in the world. And half of them will be depleted within about 12 years, completely empty. In fact, all of the diamond mines of Australia have already closed in the last 3 years. Over 40 years to 50 years, every single diamond mine that exists today will be depleted. And by the way, as these mines are depleted, as they have to dig deeper, the cost of extraction goes up very significantly. So even as they're running out, those diamonds become more expensive. So with diamonds, you have a very clear case of diminishing supply. Even if they discover new mines, they're not going to discover 40 new mines. At the same time, the demand for diamonds has been consistently growing. And in this chart, we're looking at over 20 years of luxury demand. And it grows at about 6% per year, compounded. That's really driven by the growth of the middle class around the world in countries like India and Indonesia and China. As more of their citizens enter the middle class, they start buying luxury goods, including diamonds. So those are the key drivers. You have diminishing supply because the mines are being depleted, and you have increasing demand. That's before you have the other impact, which is Diamond Standard creating financial products for the first time. That unlocks an additional 15% of supply demand from investors. As we launch financial products, the diamonds are already diminishing and the demand is increasing. We think those factors together make it very likely that diamond prices go up very, very significantly in the next 10 or 20 years. The other macro factor I want to mention, because a lot of people ask, is about synthetic diamonds. Synthetic diamonds have been around for about 6 or 7 years, and in that time, their market price has fallen by over 80%. And that's because the marginal cost of producing these synthetic diamonds is very, very low. You use high pressure and high temperature, you compress it, and the machine can make a diamond in 6 or 8 weeks. That majority of the cost is actually cutting the diamonds, marketing it, etc. The production cost is very, very, very low. It's just the amortization of the equipment. Because of this, the floor has fallen out of synthetic diamond prices. There's still a huge markup when you see them in a jewelry store because of the cost of sales, the marketing, etc. But a lot of consumers are realizing that level of markup. It can be as high as 10 times the price. The resale value of a synthetic diamond is nearly zero. You can't resell a synthetic diamond. Natural diamonds, on the other hand, over that same period have relatively held their value. And as we build commodities, you can bet that we're going to be buying diamonds from consumers, because we can't possibly buy 15% of the global supply by buying just what comes out of the mines. We would have to buy literally every diamond for 15 years, because there's about 1% stock to flow. So we think that natural diamonds will continue to hold their value. We think that synthetic diamonds will become a lot like cubic zirconias. By the way, it's very easy for a gem lab to tell the difference. Your girlfriend can't tell, but your friends can, because they will be, very suspicious of that big fake diamond on your hand. But anyway, we think that synthetic diamonds will become a bifurcated market, very much in the same way you have the original oil painting by Picasso is worth millions, and there's a very beautiful print that's worth hundreds. And the print does not diminish the value of the oil painting. In fact, it might increase the value of the oil painting by the effect of marketing. So in summary, let's review all the aspects of diamonds and the diamond standard commodities. So these coins and bars have unlocked a $1.2 trillion natural resource for investors for literally the very first time, because you can finally have price transparency and price discovery and liquidity. These commodities trade at a market price. You can buy them and sell them the next day, and you may lose the spread, but you're not going to lose your shirt the way you buy a diamond in a jewelry store and if you try to sell it later. These commodities are regulator supervised. We produce them under supervision, and they're audited by Deloitte, the process is. These commodities are traded on a spot market with a daily price. You can sell that commodity on that spot market. This commodity is enabling the launching of financial products. We have approval for futures and options, and we're filing an exchange-traded fund. We've already filed. That may take some time, but all of those financial products are going to compound the demand for diamonds, and that demand is in the face of diminishing supply and rising demand. Those things together, we think, drive the prices up. We think the investors who will benefit from this most are the ones who are able to buy early. That's by buying the commodity or investing in our private fund, the Diamond Standard Fund, which I forgot to mention is being listed on an ATS. So you can trade the shares in the Diamond Standard Fund later this quarter. What's interesting about diamonds is they have a very, very low correlation to other assets, so they're a diversifier. They have very low volatility, about half the volatility of gold, and they provide very good tail risk protection during times of market turmoil. That makes them very attractive to institutional investors. All those things together are leading to demand, and that demand is going to cause the price to go up. That's it. So Megan, let me turn it back to you and see if there's any questions.
Hi, some of the questions that I'm getting, and you might be getting some of the same ones in the queue, is can you talk a little bit about what the minimum purchase is, and what the average amount of coins and bars that clients are looking to purchase right now?
So we started offering this in 2022. We immediately sold out a $25 million IPO. Since then, we've been adding, it fluctuates as the market grows, but it could be $10 million a month or $1 million. So the vast majority of our clients hold their commodities at Brinks, and that's tax-free because there's no sales tax at Brinks. But about 5% of our clients actually take delivery. The minimum, if you were to buy one entire coin, the current market price, I think, is $4,290. We don't set that price. It's a market price that we look up on Bloomberg. So if you were to buy a whole coin, that's the minimum. A bar, therefore, is 10 times, so that's $42,900 on today's spot market. We also have a new product called Carats. Carats are a digital token that's actually issued by a bar or a coin. There's a wireless computer chip inside the bar that can issue a fractional title. So you could buy Carats in as little as a $100 increments. And if you have enough Carats, you can return them and exchange them for a coin. There's actually no fees for doing that exchange, but that's the minimum and the volume.
And I know that IRAs can't purchase the diamonds, the coins or the bars, correct?
Correct. So physical commodities you cannot generally hold in a U.S. retirement account. For those clients, we had a lot of demand. We created a fund. It's called Diamond Standard Fund. It's in the process of being listed, I mentioned, on an ATS, which is the Oasis Pro ATS. That means you can trade those shares through that venue. And by putting those commodities in the fund, you turn them into what's called a titled security. And any IRA or 401k can hold a titled security. And the fund simply is an efficient way, without messing with custody or physical commodity delivery, you can now allocate to commodities. That fund we operate in partnership with Horizon Kinetics. That's about an $8 billion asset manager. They run an ETF here in the US called INFL, which is an inflation hedge ETF. The Diamond Standard Fund, the plan is that will be uplisted to an ETF in the United States. Of course, we have to get approval for that. But that same vehicle, we think that giving people the earliest access possible to the vehicle was very important, because we think that diamonds are going to have this inflection point of price. So the fund is the way for an IRA to get access.
Exciting. So one of the other ways they could really invest is by taking their RMD off their current IRAs and purchase one of the coins or the bars.
That's right. And we think that the key is building a position, because as we get approval for the ETF, for example, we think that's going to have a significant impact on the price of the commodities. ETFs will probably buy hundreds of millions of dollars for the IPO, and if you track the history of the Sprott Uranium, that accumulation in the Sprott Uranium Trust very quickly amounted to several $billion per year. And that will have a very significant impact on diamond prices. And that return will accumulate to, obviously, whoever was earliest into the fund.
That's interesting. So I know we're getting to 11:30, but one question that I'm getting a lot of messages on is, can Cormac talk a little bit about how he feels, where the diamond fits with cryptocurrency? There's a lot of interest with the ETFs that have just launched, and kind of want to see where you think that should be positioned.
Well, it's very interesting, because the diamond commodity, it's real. It's a real asset. It's a natural resource. It's tangible, but it does issue a blockchain token, and it's very special as a blockchain native asset. The crypto token literally comes out of the physical commodity. Because of that, it's a unique type of token that is exempt from virtual currency regulations. It's literally a vault receipt, and it's not characterized as money the way stable coins or Bitcoin are characterized as virtual currency. This means that the Carats tokens can be used for payments on a platform like Twitter, where they wouldn't need to get a money transmitter license and able to handle those payments between their users, because they're actually transmitting commodity titles and not currencies. So we're only in the very early stage of launching Carats. We haven't even done a public announcement yet, but you can see it on our website and learn more. But we think Carats are really a unique digital asset in the world that unlocks a lot of use cases, like payments or remittances internationally, or gaming in games or in casinos. There's a lot of applications.
Can't wait to see more about that, Cormac. Well, it's 11:30, and I want to thank you so much for your time. We're getting a lot of messages how interesting this is, and we'd love to continue the conversation with you. So we will be sending out the recording of the webinar, and it will have our contact information. Please feel free to reach out to us. We would love to have a conversation with you, whether it be for physical precious metals, diamonds, or a little of both. They're both real assets, hard assets for your clients, and everyone's looking for something new and unique in their portfolios. So with that, Cormac, we will let everyone go. Thank you so much.
Thank you.
Have a great
Thank you,
day.
Megan. Bye-bye.
Bye.